I want to bring in Matt McCormick, who joins us via remote. He's with Bahl Gaynor and manages about $4.5 billion of assets. Matt, thanks for joining us. Let me tell you, or let me ask you, what do you make of today's rally? Are you buying today?
Well, we're long-term investors, but I think when you look at a low-volume day with many people not showing up based upon a hopeful yet another plan coming out of Europe, I'd say enjoy the rally, but I would bet on more sustainable growth plans, what Stephen recommends, companies in tech, consumer staples, but especially dividend-paying stocks. So we were buying dividend-paying stocks at this time, and we think this rally is probably quixotic.
Matt, we just had Mark Grant on earlier in the hour, and he's extremely bearish on everything Europe has been for the last year. But I thought was interesting was that he's fairly optimistic on U.S. banks. Now, many others have sort of tied what's happening in Europe back to U.S. banks. Today, of course, we're seeing a rally across financials. Are you a believer that U.S. banks are in good shape and not as exposed as some think to Europe?
I think you need to be very selective. There are some regional banks which are probably going to be better players than others. But I think when you look at what is potentially going to occur in Europe, and let's just say there is not a default in Greece, which I find unlikely, I still think there's going to be significant economic hurdles for Greece and the EU, and I think that's going to hurt the European banks, and ultimately it's going to impact our economy and our financials. So I think it's right now it's better to avoid them. If Greece does default, which I think is the case, that is certainly going to impact the European banks. It's going to impact the partners over here. I think when you look at third-party counterparty risk, which is very difficult to measure, I've seen estimates all over the place. I think investors, if they go through what I think will be a very emotional trade, it's going to impact the financials more than people expect. I think people are going to sell first and then do the calculations later, and they're going to conclude, whether unjust or justly, that many of the U.S. money center banks have more exposure than they are letting on, and they're going to sell them. And I think the point I want to make here is you don't have to own financials. You don't have to own the money center banks. You can find other areas to invest in with a little bit more downside protection and income. And I think if you are investing on them, you have to hope that the European plan is successful. But remember, we've heard plan after plan come to a proposal, and there's never been any results. And I think when they do finally come to one that the market does like and is actually workable, sure, we'll take a look at it. But for right now, I'm a little bit cynical that will actually work.
Hey, Matt, I know you got out of the banks back in 2007, but is there anything, in spite of what you're saying near term about the banks, is there anything on your longer term shopping list in the banks that you might like?
We do like the Canadian banks. They have strong dividends. They have limited exposure to Europe and the U.S. and very strong dividend yields, a very strong economy. There are some selective regional banks that we're looking at now. One of them is U.S. Bank, which we don't own in our discretionary portfolios right yet. But it's something where I feel the need to see stronger dividend increases is going to be the catalyst for us to potentially invest across the board. I think that a strong dividend increase signifies future health, future confidence, and it's something that I think more people need more income. And if a bank can do it today in bad times, they can certainly do it in good times. So I want to see more dividend increases. I want to see more clarity, and I want to see, I think, a little bit more visibility in the entire market.
Matt and Stephen, I want to share a couple of thoughts that we heard earlier from one of our guests, Jonathan Golub, chief equity strategist at UBS. He was on Bloomberg just earlier, very optimistic.
Right now, what we're debating is something which is very sick about the overall story, which is the fact that that Europe has these headwinds. So once we're focused back on earnings, once we're focused back on U.S. GDP and the next jobs report as compared to Europe, that means the stock market's probably a lot higher than it is today.
So, Matt, certainly he has a point that we're very focused on Europe. In fact, I can't remember a day when we haven't talked about Europe at our closing bell. But earnings season right around the corner. Do you think sentiment can change dramatically over the next, say, week?
I think you're going to see selective winners and selective losers. It's going to be very volatile. I think people are expecting for about 14% year-over-year earnings growth this quarter, and I think they're probably a little bit too optimistic, especially on the financials. I'm on the side when you look at what happened since August, it certainly have to impact investment banking, revenues associated with capital markets, IPOs, et cetera. I think you may see some selective loan growth, and that may increase, but it's not enough to move the needle. And I think the estimates that are coming out are going to drive the market. You're going to see macro events, whether it be plans or earnings. I think we're going to be in a top-down, event-driven market. I agree with the UBS strategist that once we get past Europe, we'll have cleaner sailing. But that's like saying once you get past a heart attack, you'll be okay. This is a very big issue. There are no easy answers, and I think the odds of them being easily defined and clarified are slim and none. I think we're in for a tough sledding, a grinded-out economy, and if you're going to invest in anything, buy the dividend-paying stocks that give you more downside protection and income. I think you need to understand that this is going to be a very difficult market. Be selective, invest realistically, and I think invest conservatively.
Matt McCormick from Bahl Gaynor manages about $4.3 billion. We thank you for joining us.